Hi everyone, welcome back to the Property Finance Podcast, and today we're carrying on our series of frequently asked questions. And again, today I'm joined by Adam Powell, who's been with the Property Finance Collective for about 4 years and is here to share his expertise on all things property finance. So today we're talking about exit strategies. So we're talking about essentially how to exit bridging finance and development finance and the different exit strategies that you could use to get you out of trouble should you be in trouble. So Adam, talk to us about exit strategies when it comes to bridging finance and development finance.
Well, when it comes to development finance and bridging finance, you've always got to think about the exit. You don't want to be in a bridging facility or a development facility for longer than you need to be. And the lenders will always want to know upfront, what is your strategy? So really there are three. The first is sale, if you're going to sell the units. The second is refinancing. And the third is a mixture of both. So they may sort of sell some of the units, they may retain some of the units. When it comes to refinancing, this has been, I would say, about 2-3 years ago, when the lenders used to ask us about, what's the exit strategy. Typically, if we went sale, they went, okay, fine. If we said refinance, they would go, okay, that's okay. But since the sort of the rate increases that we had over sort of end of 2022 through to 2023, which was like 14 consecutive increases, a lot more focus. If we turn around or the client says, yes, I'm refinancing,
they want to see evidence now.
They want to see some evidence. So it's not just about it's refinance. The lenders now go, okay, what's the rent?
With who?
Who's it going to be looking like? So it's important that when we do talk about things like, what's the GDV and what's your exit strategy? It's going to be refinances. Okay, great. We now need to know what's the rent, because we want to sense check that it's a viable option, and we can demonstrate.
We essentially need to underwrite from our side. Obviously, the lenders do their underwriting process as well, but essentially, we as brokers now need to do our underwriting process on actually, have you got enough experience for development finance? Great. Well, actually, we now need to analyse, have you got enough experience, enough portfolio experience, enough net worth, etc., to refinance those assets? Because if you're developing 40 units, for example, you might have the experience as a developer, but actually the minute you try and get a refinance on 40 units, for example, have you got that experience? Have you got everything to tick the boxes for those term lenders? And if not, refinance is off the table. And I think that definitely has made our job harder over the past few years in terms of actually underwriting that side as well.
Yeah, and I think what the lenders are really look at now, because obviously their loan books were a little bit under stress when, certainly around 2023, when the rates went up and nobody knew when it was going to end as far as the rate increases were concerned, was that a lot of the exit strategies that they had last year with the clients were no longer viable.
Yeah.
So they had to switch to alternatives like selling, for example. So a lot more focus is now put on that. And clearly we don't want to, we'll do our due diligence. We don't want to put somebody into a facility that they can't get out of.
Yeah. Because naturally, if we do, the first person they come back and come out is us.
It would be irresponsible for us not to do some sense checking with what those strategies are going to look like if it is going to be refinance. And sometimes that's why we're seeing a lot more sort of part and part, selling some of the units, retaining some, because sometimes it means that how many do they have to sell to reduce the debt enough for us to then start looking to refinance some of those units back out again. Because it fits.
And that's due to the interest rate increases, isn't it?
Yes.
The rental coverage isn't enough for maybe the ability to refinance everything in one go.
Yes, and all the lenders have their own affordability calculations that they adhere to. So it's down to us to make sure that, they can do their own calculations, but we need to stack the odds in the favour of the client. We need to make sure that we've got at least 3 options on the table to demonstrate that yes, we've looked around. Here's some lenders. Here are the products that they fit on, and so we're confident that they can exit at a particular time.
And if they can't exit, so let's talk about bridging finance first. Realistically, because it's everyone's biggest fear is they've signed up to a bridging loan, there's personal guarantees involved. What are the repercussions realistically if that bridging loan starts to get close to term or even runs over term?
Well, that depends very much on the lender, which is why we're very conscious about who we put a deal with. There are some lenders out there that are very accommodating. They'll rather than the worst case scenario is they fall into default territory. They go beyond the term. They fall into default territory. They can get charged fees. The interest rates can go up massively, and you're going to have to service it each month. And if you don't, then that causes no end of problems. You then get the receivers appointed, etc. That's the last thing you want to happen. But there are some lenders out there that will work with the client to make sure that doesn't happen, as long as there's they can see the light at the end of the tunnel. So,
and how does the client help that? Because if they're getting close to term, or at what point do they need to be engaging you and I or the lender, etc.?
If it's starting to look a bit choppy, I would say a good few months, at least 3 months beforehand. And so
3 months before the term comes to an end.
At least, because then it gives us time to then help them and liaise with the lender to say, okay, this has happened. There's been a delay, or there's a sale fallen through.
Yeah,
they need more time. And
people are going to ask, why does it need to go on for 3 months? But I think it's worth explaining that these things aren't quick things, are they? In terms of getting extensions, in terms of negotiating those, because when a bridging lender is lending money, they have a term, so 12 months, let's say, for example. They have agreed that with their funding lines, they've agreed it with their investors, whatever it may be. For them to run over that, they've obviously got to get permission to do so from their funding lines. They've got to get investors on board, however they're funded. And I think it's worth mentioning that the reason it takes that long is because they've got to go through that credit process, that underwriting process, that risk assessment period of, if we give an extension for another 3 months, is that enough? Are they going to get out of it? Or is it even worth giving the extension? And I think leaving that to a month or a couple of weeks before the term comes to an end, it's never going to happen.
No. And you know, the key thing is don't stick your head in the sand. Just be transparent. Yeah. You've got to be, as soon as you see any challenges pop up, highlight them straight away, because that is key. The lender will appreciate it. Certainly we will, because obviously we'll help negotiate that with the lender as well, as to, you know, how long do they need to extend this for? Because if it means that, and sometimes the lenders will say, well, okay, if we extend it another 3 months, what's going to happen in 3 months? Yeah,
what's your exit from the extension then?
Exactly,
at that period.
Yeah. So is there if it's refinance, have you got another lender lined up? Or if it's sale still, and you've had somebody that just fallen through, have you got somebody else lined up to purchase it? So it's but the sooner you've identified that there's a challenge that with the exit strategy, you stick your hand in the air straight away, and then so we can deal with it.
And with bridging finance, it's worth mentioning that in terms of the refinancing options, realistically, we can rebridge. We could look at buy-to-lets if that's appropriate. It's bringing in investors, etc.
Yeah, it's not the ideal situation. There are lenders, bridging lenders out there that will rebridge. Yeah, it's an expensive way of doing it.
Absolutely,
but it's
extensions are essentially the route of,
extensions with the current lender is the preference.
Yeah, the path of least resistance.
Yeah, exactly that. And as I said, we only really deal with those lenders that are that flexible, because there are some ones out there that are rather draconian in their approach.
Oh, absolutely. I mean, we've got lenders who, we won't put a lot of business with them, but who, the minute you go over a 5% default fees, for example, if you a day over term, 5% straight away. Yeah. Plus, you're then also servicing the interest at 2%, 3% a month. It's
exactly that. We tend to try and avoid those as much as possible.
Yeah, absolutely. So when it comes to development finance, there's probably a couple more options that you've got in terms of how you can get out of a development loan that's kind of coming to term. So do you want to talk through kind of development exit?
Yeah, well, this happened a lot, particularly last year when developers had pre-sales lined up, and then those pre-sales were sort of evaporating because the mortgage that the client, the prospective purchasers were going for, was sort of evaporating rather rapidly.
Yeah.
So all those sales are sort of fallen by the wayside.
Chains were falling through left, right, and centre. Yeah, it took a lot down.
So they then have to think about, okay, well, I'm coming to the end of the term of my actual development facility. Some of them, again, you can renegotiate with the development lender and buy some more time.
And development lenders tend to be a bit more open to that as well, don't they? Bridging lenders are far more aggressive, but development lenders tend to be
the last thing they
slightly more flexible.
The last thing that the development lender wants to do is sort of have to sort of go in there and they will work. Because they'll know what the situation is. They know what the market's doing at any given time.
Well, for a bridging lender, it's far easier to take over a single asset and do something with that single asset, as opposed to a development lender trying to take over a half-built site or 13 units that don't have sales lined up, etc. It becomes far more complicated.
Yeah. So if indeed, as we saw last year, with developers having to have more time to sell them. Sometimes the development lender may turn around and say, look, we just can't do it.
Yeah.
We just can't do it. At which point we then look at another exit strategy, which effectively is to buy the developer more time, is we'll provide go to a few bridging lenders, get some terms on a development exit bridge.
Yeah. Or a sales bridge, as it's known sometimes.
So that can be for 6 to 12 months. Gives them more time. It clears the existing development facility. And the irony here is sometimes those development exit bridges
can raise equity as well. Yeah.
Can raise equity, and sometimes they're even cheaper than the actual development facility.
Yeah.
On the odd occasion, but at least it buys them more time. And there's been if you look at a lot of the bridging lenders, all of them have got these development exit bridging facilities.
Because they know things run over them. They've seen a gap in the market of we can provide the development finance and actually double bubble. We can then sit on it for another 12 months on a sales bridge and get out the other end of it.
So
as well.
whether it's with the existing lender or whether we have to go to a different bridging lender, the key thing is making sure that there is enough time for the developer to sell those units. And again, don't stick your head in the sand, and hopefully it'll all go away. It won't. But it's again, if you like many of the developers that we've seen in the past, we've always said to them, stick your hand in the air if there's any problems.
Yeah.
Keep the communication going, because we're here to help. We're not just here to sort out the finance for you. We're going to hold your hand through the process, and at the back end as well.
Make sure that you're right there as well. Yeah,
exactly.
And those sales bridges, the lenders that provide those dev exit bridges tend to be the same lenders that offer, for example, wind and watertight or part completed developments. And actually, those products, yes, okay, they're there if things go wrong, but actually, if they're used in the right way, they could actually be used halfway through a development in a smart way to raise equity and to enable you to actually, if you've got another project on the go that you want to go and invest in, a way of raising equity at the point of wind and watertight. And
we've done that a few times where there's nothing wrong with the fact that they're coming close to the end of the facility they got with the development lender, but they need more time to sell. But at the same time, there are development exit facilities where they can not just clear the existing development lender, they can raise equity as well, which enables them to move on to the next project.
Well, it's a smart way of maybe first-time developers as well, if they're on expensive development finance, which might be 12, 14% per annum, actually getting halfway through the development and going, right, okay, we're at the point of wind and watertight now, let's refinance to another lender who maybe they'll sit at 8, 9% per annum, but because it's halfway through the development, it's a way of raising equity, but also a way of bringing that interest rate down as early as possible, rather than sitting on that development finance for 12, 15, 18 months, however long it is, and racking up that debt at 12, 14% per annum. They 6 months in, get to wind and watertight, refinance, bring that rate down for that remaining time period as well. So I think it's not only if things go wrong, is it? It's about playing the smart game of.
It works both ways. So it's the key thing is that what's right for that particular developer at that given time, and we can turn around and say, do you know what, is that the right option for you? Does it if it's an equity play, then fine.
Yeah.
If you want to raise some equity doing that's fine. But similarly, we want to make sure that is it right? Is it right for them to come out of their existing development facility?
They understand the costs of
exactly
coming out. And it's all well and good putting someone onto one of these facilities and raising 200-300 grand or whatever the figure is. But actually, how are they then going to go and use that money? Because if it's just going to sit in a bank account, chances are the lender doing the wind and water bridge, if we call it that, they're not going to be happy with that money just sitting in an account. They need to know what the use of funds are. They need to know where it's going to go. So it's not just a case of halfway through development going, right, we're raising 200-300 grand. There's got to be a use for it.
I might find a site that I like. Okay, well that's great, but you might not. So it's making sure you've planned it out properly, that you have got something lined up and you definitely need that money, rather than trying to raise that capital and go, right now I'm going to see if I can find it, because you may not.
No, exactly that. Brilliant. Thank you very much, Adam. And to everyone watching, thank you very much. Catch you on the next one.